Thank you, everyone. It's a pleasure to be here. Welcome to Leveraging Risk, Rewards, and Results. My name's John Carrier. I'll be the moderator today. And very brief about me and why I'm here. I'm a senior lecturer at the MIT Sloan School of Management, which in the System Dynamics group, which means my primary focus is in operations and supply chain risk. And I've spent a great deal of my career in high-risk industries, ones where people can get hurt, and other types of very serious events we'd like to prevent. And one thing I've learned through that experience is when organizations have crises, it brings us together, right? And it's often said that that's a good thing, and it's not a good thing that the crisis brought it together, but we all start to realize whatever function we're from in the organization, risk is a systemic property of the entire organization. So it's exciting for me as an operational person to actually share the stage with our panel today. We have three CFOs, and we also have a senior VP and an expert in tax health insurance. So what I'd like to do is I'll just briefly introduce the panel, and if you could just tell us a minute or two about yourself, your role, and some of the key risks you focus on, and then we'll step into a fireside. So first, I'd like to start with David Chavez, who is currently CFO for CVS Health. David?
Thank you very much, and thank you very much for the invitation. A real pleasure to be here. I am the CFO of Shared Services within CVS Health, and I also work there as the Chief Procurement Officer. So talking about risk, definitely a lot of areas that we have to oversee. And in my past experience, I've been a Chief Risk Officer of 3 publicly traded companies across industries, across locations, all the way from global organizations to more US-based centric type of organizations. And again, a pleasure to be here.
Great. Thank you, David. And next we have Sarah Romano, who's currently the CFO for First Wave Bio.
Hi, everyone. My name is Sarah Romano. I'm the Chief Financial Officer of a small pharmaceutical company called First Wave Biopharma. We are a pre-revenue company focused in research and development for gastrointestinal diseases. My background is I'm a CPA. I started at PricewaterhouseCoopers, and from there went to various SEC reporting and controller positions, mainly for publicly traded companies. The last decade or so, I entered the pharmaceutical world. Being a very small and research-focused company, we don't have a lot of resources to dedicate to risk management, but we do prioritize it because we have a lot of capital restrictions and resource restrictions. So we have to make sure that we carve out time to address these, because for a company like us, any little bit of fraud or security breach is a huge deal. So it's great to be here. Thank you.
Great. Thank you, Sarah. And Peter Banat, who's the CFO for Bay State Building.
Yeah, thank you. Also very happy to be here. Bay State Milling is a $1 billion company in food ingredients. We started out in flour milling, so buying grain, grinding it into flour, selling it to Pepperidge Farm and Little Caesars Pizza, and we have really driven into some specialty ingredients as well, very agricultural based. If we think about some of the risks that we need to deal with, we are driving innovation, so we are developing new specialized ingredients. We have a flour that is healthier for you that we've been developing for 12 years, and we can now make a pasta, for example, that is healthy and tastes as good as regular pasta and has a better nutritional profile than whole wheat pasta, for example. From a risk standpoint, some of the things that we have to deal with is food safety. Some of the things that we have to deal with is commodity risk. Russia invades Ukraine and the price of wheat jumps by quite a bit, and we've got to be able to manage that position. So it's very, very broad, in addition to the normal risks that all of us face: cybersecurity, fraud, et cetera. My background, I've been at Bay State Milling for 10 years. Prior to that, I started my career with Goodyear Tire. I was there for 10 with PepsiCo, and then I was in private equity doing crisis work for private equity companies in their portfolio for a dozen years, as I said.
Thank you, Peter. And finally, we have Daniel Berger. He is a senior VP and head of tax insurance for Lockton Industries. And Daniel obviously provides us perspective across many industries. Daniel?
Hey everyone, it's great to be here today. I work at Lockton. Lockton is the largest privately held insurance broker in the world, $3 billion plus of revenue. I lead our tax insurance group. I work very closely with CFOs and other C-suite executives in terms of helping them to manage tax risks. Specifically, companies get advice on a routine basis from really smart external tax advisors. But ultimately, the IRS could still challenge the position, and a company would still have to pay the tax and potentially interest and penalties as well. We work with CFOs to get financial guarantees to protect against that type of downside, and we work very closely with specifically on tax, but also across other types of transaction liability products like rep and warranty insurance as well in the M&A context.
Thank you. And I'd like to start off with the first question is, if you look at historically the chief financial officer function, the role of managing risk has really changed over the past 20 years, particularly over the last 3 to 5 years. Perhaps a great place to start is to talk about how your role in managing risk has changed for the CFO over the past 3 to 5 years. And why don't we kick it off, Peter?
So as I shared, I've been in different industries. So one of the things that has changed is there are different risks based on the industry. I worked for a company called Evenflow. Evenflow is a car seat manufacturer for infants. You have lawsuit risk all the time, and so you're managing that. But as we moved into the food industry, food safety becomes one of the risks that we manage. But more and more, being held accountable to make sure we are proactive about managing risk. One of the things that we do is every few years we do a risk assessment, an enterprise risk assessment. We did one a couple of years ago, and so the board is going to push us to renew that. But we also, so that looks at a broad range of what the risks are that the company faces, making sure that we understand both the likelihood of that risk happening and then the magnitude of the impact of that risk if it does come in play. And we had about a dozen items that were identified as potential significant risks to the company. And then we need to work with everyone in the company in order to make sure we have mitigation plans in order to minimize the impact and proactively manage against those risks.
Thanks. And David and Peter, you raised an interesting point when you start thinking about how the risks have changed over the past 3 to 5 years. That needs to be reflected in your organization's risk register. And it's probably a good point for all of us to reflect on where our company's risk register is and how it compares to our colleagues and competitors within that industry. David, at CVS Health, maybe you'd like to talk about what you see in that area.
Yeah, thank you. And I think it's very important to also think about sort of the regulatory changes that have happened in the last 10 years. I believe CFOs have become the de facto chief risk officer within the organization. If you don't have a figure or you're not required, if you're not in financial services and not necessarily required to have an official chief risk officer, CFOs have sort of come in and tried to ensure, right, that the right information, the right analysis is being done on a regular basis, and particularly with the audit committee requirement of overseeing risk management within the organization if you're a public company. So I think within that, right, I think the regulatory environment pushed for a lot of those changes that by de facto many CFOs ended up taking that responsibility and going beyond just the financial reporting, but starting to look into operational risk management, compliance risk management, and very importantly, strategic risk management. How is the strategy of the organization being educated through risk management? And I think like many other public companies, right, within CVS, we have a very structured approach in which we look at both top risk within the organization, but one of the big changes was to start actually looking from the bottoms up as well. There's many cases, right, where risks are being managed and decided upon within the organization. So having the level of visibility and the right approach to be able to escalate those risks is very critical. Because you will see how many times people at a lower level in the organization might be making decisions that affect the entire organization or could become significant risk to the organization, and there's not necessarily a proper mechanism to be able to escalate those and provide the right level of visibility.
So, David, you made a couple important points. First is the CFO is becoming a de facto chief risk officer as well, and actually make that formal and follow the processes and procedures. And second is the feedback from the factory floor. So when I'm working down there and I'm helping people make very dangerous decisions, I will make sure to give you a call. And that takes us to Sarah, who's got a very interesting risk profile, because you're actually working with R&D portfolio risk in a high-risk, high-reward industry. Can you tell us about that role?
Yeah, I mean, we, not only do we evaluate external fraud and external risk, but internally, we do constant evaluations of risk-reward profiles. So, right now we have a portfolio of 3 drugs that we're developing. In this particular time that we're in the last few years, capital has been very, very difficult to raise. So, we have to decide internally, like strategically, what makes sense for us to put our capital resources in. We do both external, fraudulent type assessment, but also for us, it's very, very important to do internal assessments of where to align our capital needs and where strategically it makes sense to bring value to our shareholders.
And to add to that, Sarah, since you're working in a high-tech organization as a CFO, it also indicates you have to have a certain understanding of the technology and relationship with the researchers. Could you tell us a little more about that?
Yeah, again, being very small, we communicate with our internal teams at least weekly, sometimes more. We have team meetings every week. So the whole company is always aligned with where our strategic position is. So for us, rather than making budget cuts necessarily, we look to push timing out. So we all get together and figure out strategically, like where should we spend our money, our time, our resources kind of now, and where can we kind of push things out so that we're not necessarily cutting things from our budget, but we're kind of reshifting things and reorganizing things to make sense for creating the most value in what our situation is currently and what the economic environment is like currently.
Great, thanks. And of course, it always gets down to taxes, right, Daniel? So one of the things you get to see is you help companies across multiple industries handle these issues, and they're regulatory because they're taxes. Based on our CFO's perspectives we've already heard, what do you see as really, in the past 3 to 5 years, falling on the CFO's plate to deal in terms of risk from your perspective?
Sure. I would say there are probably 2 things I would identify. The first is in the context of M&A transactions, we're seeing the use of rep and warranty insurance really become synonymous with any type of, certainly private M&A deals and even in the public space as well, where companies are using rep and warranty insurance, doing diligence, but also using rep and warranty insurance to facilitate transactions to occur. And it's really been tremendous, the amount of growth in that space. Our industry did almost 5,000 M&A deals last year alone. And then the second, more recent trend I would identify is the fact on the tax side that the IRS has now been funded for the first time really in decades. And that additional funding is, they've made it very clear, both the IRS, Treasury, Congress have made it very clear they're going to focus on large companies with large balance sheets. And that's something that CFOs, I think, are very much attuned to and concerned about, that, the IRS is going to become more aggressive and look to extract their pound of flesh. And we've seen that really impact how companies are looking at risks, especially in the tax space.
So I just say, as a system dynamics person, I'm paying more taxes for the government to do more due diligence and push on those taxes that pays me my salary. So that's the system dynamics loop world I live in. And so I've had the opportunity to talk to this panel several times, and one of the things that really struck me is a few years ago, you build your risk registers and you list events, most of which wouldn't happen, but they'd be there in case it came. And now we're moving into this world where things are just happening much more quickly. So what do you see as your challenges over the next 3 to 5 years in terms of risks, and what are some important new risks that need to be managed by CFOs that they might not have had to think about so much in the past?
Well, I'll start. I think there's actually 2 questions. One of them is, what did we not think about so much every one of us is worried about cybersecurity. We just did not worry about that 10 years ago. And it is an ever bigger risk. We do a lot of activity on trying to protect against cybersecurity, and we are only as strong as our weakest link. And there are so many stories, and for every story we've heard, there's probably 100 that happened underneath the radar that we never found out about, if not 1,000. Another thing for us, because we are innovating, and I think similar to you, is you're investing in innovation, and you're getting out front. So as a result, you get exposed to the risk that your innovation will fail. You get exposed to the fact that it'll take longer than you expected. So there's how much cash are you going to put into it before you pull the plug are all parts of the things that you look at. In our case, when we innovate, we need to build a supply chain. And when you build a new supply chain, putting in the right controls. We just faced a fraud. I was talking to you in the hallway about it, but we had our first fraud that we caught where one of our supply chain partners ended up stealing $2 million worth of inventory that they were responsible for, and that had we not created this whole new supply chain, we would have been able to put our normal controls in place. So when you're innovating and you're going out and you're doing new things, there are new controls that you haven't thought about and that we need to be proactive about as we move forward in the next 3 to 5 years. So,
Catching the fraud also shows that you put into place some good controls also, right?
Yeah, but you never feel like you caught the fraud soon enough.
Yeah, I would say, we heard it, I think, earlier this morning, the continuous change in the regulatory environment, right? And as you mentioned, not only from the new regulations being introduced, but also the enforcement side. I think both of those continue to play a significant opportunity for organizations to think about how robust your framework is. And in a previous life where I had the opportunity to work with CFOs and chief audit executives, chief risk officers, providing advice on how to establish risk management frameworks, I always like to say it's very important to look at it from two perspectives. One is to try to look into your crystal ball and figure out what's coming next. Think about your strategy, new things that you want to do, innovation that you want to do within the organization, and where is the company headed, and stop and pause and say, do I have enough visibility of what the risk environment looks like in that specific market, in that specific technology, in this new product, in this new client that I'm trying to take? Or as you're changing your business model, how do I see the risk that is coming in front of me? And the second one is the robustness of the effectiveness of your control environment, right? Because in many of those cases, and again, I've been hearing cybersecurity for the last 10, 12 years, but if you look back and see the major incidents from cybersecurity are very basic schemes, right? It's technology that failed, patches that didn't get done. The complexity is not necessarily significantly increasing. It is very basic operational processes that were exploited in order to get there, right? So I think it's always important to think about, yes, the future and what's coming in front of you, but also how robust are your existing operational processes to actually identify and mitigate those risks.
And I just have to make one point. One of my, I focus on organizations is what's called continuous improvement. Do you all run and support continuous improvement in your organizations? Are you really excited about doing that? And what I found is, and thank you, David, without those small continuous improvement efforts, make sure all those small lingering risks that we all know about actually get fixed. And so, without support from the CFO office, it's not sustainable. You also, it came up this concept around, you're actually responsible not only for your own company, but the supply chain's risk, right? And Sarah, given that your biotech startup's position in the supply chain is very interesting, your in innovation, you're fast moving. What would you tell us about the challenges of risk in your supply chain? Maybe you've had advice for some of those large companies you work with.
Yeah, and I think just to piggyback a little off what we've been talking about, I think this is where the CFO role has really changed, is that risk mitigation while I've seen that it's always kind of ruled up somewhere along the line to the CFO, I think it's always been kind of a check the box type activity where it's like if you're public every year, you're doing your 10 pages of risk factors, but are you really thinking about these risk factors and how they may impact your company? I think now times have really changed. I think that there's real fraud out there, that these cyber hounds are getting very sophisticated. We've had multiple times where vendors have been hacked actually, and they've reached out to us, and they will have the right signature, they'll have the right email addresses, they will have an invoice that looks exactly like the vendors. They're just getting very, very sophisticated. So I think I kind of diverged a little bit, but I think this is where the CFO role has evolved a lot, because at the end of the day, most fraudsters are looking for cash, and as a CFO, you're responsible for that. So it's very important that you're not just going through the motions. You're taking the time to really think about what the company's risks are and what needs to be addressed to prevent something significant from happening to your organization.
Yeah, if I could just piggyback on that, I think one of the other pieces that we need to do is we need to really engage the rest of the organization, because there's no way we can prevent all the risks from the CFO office. And so part of our responsibility here, whether it's cyber, whether it's supply chain fraud, whether it's regulatory issues, is to make sure that we're raising it to all, the CEO, to all of the peers, and that everyone has consciousness, it's being tracked, it's being managed. So we can be the voice, and it's part of those communication skills that we talked about at the beginning of the introduction of the conference. But we have to engage everyone at the senior level to be conscious of risk and to help us manage it. The buck stops here. We're usually the ones held accountable when there's a fraud and we let it happen, or there's a major problem, but we can't do it alone.
And just from all three, is just that role that the CFO is really responsible for engaging the organization rather than just the quarterly check the box. And Daniel, your perspectives would be interesting given your role.
Yeah, I mean, I think being there as a CFO, being visible so that people know where to go to when they have questions is, I think, really important as a CFO. I think certainly, one of the things that we're seeing that's sort of interesting in terms of going forward, companies that have large tax bills can now, there's been a big push in ESG for companies to invest in renewable energy. And we've traditionally seen that renewable energy companies have been focused much on that sector. And now companies can freely buy a tax credit for the very first time. That was new legislation which was enacted last year. So now we're seeing companies that have a $50 million tax bill buy a tax credit at a discount, 10% discount, and only have to pay $45 million. And that's something that CFOs are doing, again, as a way to increase cash flow and save on their tax expense. And that's really a new thing. But it's been interesting to see how, again, CFOs are sort of tasked with making sure that they can achieve those savings, but also make sure they can manage the risks associated with buying those credits, right? And that's been a major theme of some of the policies we've been seeing.
Thank you. Great. And in a moment, I'm going to open it up to questions for the audience. But before we do, I just wanted to get your perspective on what are the next 5 years going to look like, and is there a specific role technology can play both in terms of the challenge, but also helping you manage these risks?
I think that's a great question, and let me just sort of spin the conversation a little bit, if I can, John. But I think in many cases we look at risk as something negative, right? But we've all heard it, right? With risk comes reward, and in many cases it's about finding that right balance of how much risk are you willing to take for the reward that you see in front of you. And I think in many cases, right, that discussion around risk is not profound enough to be able to really go in with eyes wide open into what are those specific risks that you want to do. And at the end of the day, I tell people, look, it's either you're going to accept the risk and move on, you're going to try to mitigate the risk, or you can insure against the risk. right? But I learned through the process, right? And I had the opportunity of standing up a risk management framework for Dell computers and sitting down with Michael Dell. He said, David, day one, I don't want this program to prevent the organization from going forward and not taking risk. It's about taking informed decisions based on risk. And I think our jobs as CFOs is precisely to provide that framework and the visibility into what those risks are for the organization to be able to take the decisions or make the decisions. And lastly, and sorry for the long comment, but and I think when you think about technology, we heard it earlier this day, Gen AI, a lot of utilization of new technologies brings different risks that you have to evaluate and you have to have visibility, but it also brings potentially significant rewards for the organization. Being able to go faster in certain actions, being able to take up productivity as part of the process, change the mindset of your team members to do other skills or look for other skills and have better opportunities to analyze data. Right now, instead of having one of my team members work for 3 weeks to get me a report, I can get the report in half a second and now have the time to actually analyze the information that I'm getting out of it. So I think finding the right balance, right? But I do think the use of technology in the future, do more correlations across the enterprise, have the ability to correlate data is going to be very critical to better inform what the risk within the organization might be.
I would sort of just add to that, what you were saying in terms of risk bringing a reward. I think CFOs are also in a unique position that they're able to help sort of make sure that the risks being taken by a company are consistent, right? And sort of having a risk profile in one area that's very different from another area is a problem, right? But you want something to be uniform in terms of the risk profile across an entire company. And I think CFOs have a unique position in terms of being able to oversee all of that.
Yeah, but the practical nature of that is you cannot, some risks are going to be more severe and more potentially damaging. You have to mitigate. Again, if I pick our industry, food safety, there are a lot of things that we can be doing and managing on the food safety side that also include insuring the risk, right?
Correct.
So if we have a recall, I have recall insurance, and if you and you put in processes and so forth to minimize the food safety. But there are things like our commodity exposure that it's just part and inherent in the business, and you have to manage it the best you can and operate effectively. We're all going under and living under a interest rate environment that is impossible to control. And so if you have a certain amount of debt, and your interest expense is going to go up. And we're talking about tax in the 2017 tax rule. We now have a cap on what we can deduct of that interest expense. And so as it goes up, we're kind of caught because it's going up higher, and we can still deduct an amount no matter how much the Fed raises the rate. So we work on trying to mitigate it. Maybe we can put in hedges and interest rate swaps, but we're only going to be able to do our best, and we have to understand the practical nature of it. So.
And then from my perspective too, I don't think things in the cybersecurity world, in terms of people trying to commit cyber fraud, I don't think it's going to get better. It's probably going to get worse. Technology is getting better for us, but also for them. So, I always just try to use common sense. Like sometimes, if something doesn't smell right, almost 95% of the time, it probably isn't. So, there's still that human factor that we can, keep our antennas up. And if something doesn't seem like it's right, investigate it. Just take that step back. Everyone's so busy. Sometimes it's easy just to, you see something strange, and you just it's fine. I don't have time for this. But just, take that step back to kind of digest it. And, that's probably one of the best ways to kind of, mitigate something that's not accurate.
So we actually have a firm that provides us with training programs that every month, every one of our employees has to go through. And we do sort of fake cyber threat emails. that people may click on. It says, got you, okay, you got to go back and do more training in order to raise the awareness at all levels. And that's been invaluable. And then we have metrics on who's taking it, who's not, and who keeps making the same mistake and putting us at risk. But it's really hard, and the crooks are just getting smarter and better, and it's really hard to stay ahead of them.
Yeah, we've seen a lot of employees fail that. A lot of them expect free gift cards from their managers. So it is something we see a lot of people fail.
Yeah, we've actually done the same thing. Again, you say we're small and capital, restrained, but we do put, a significant or a somewhat significant amount of money into our IT because it is that important in the training and what you're saying. Yeah. So yeah, I think that's very important.
Yeah, and I think something that I haven't necessarily seen a lot of companies go into is how mature is your risk response team or plan, right? These things are going to happen, believe me. Everyone in this room is going to get hacked at some point in time if you're not already hacked. And I think it's about accepting that reality. Once you accept that reality, is how ready are you to respond to that? In a moment of crisis, is your crisis management team ready? Have you identified proper roles and responsibilities? Who is responsible to keep audit committee, board of directors informed? Who's responsible to responding to PR, media, et cetera? Who is going to run the actual crisis management within the organization? These are a lot of things that can make a significant difference in how the public may perceive your actions in that moment of crisis, right? So I always encourage people, always think about when it happens, how are you going to react and are you ready to do that? Have you done enough tabletop exercises with your teams? Do you have right rules roles identified within the organization? Do you have a PR firm? Believe it or not, the cost of a PR firm in the middle of crisis is going to be significantly bigger than having somebody on retainer. Right? Do you have the right legal teams, both internal and external, ready and locked down to be able to respond? Many of those things is, again, you won't have necessarily a crystal ball to say what is going to happen where, but there's a lot that you can do to be ready for when that happens.
And just from across the panel, it's something that we can almost think is we have to be prepared to win the fire drill, right? Mm-hmm. It's not something that excites the organization, but actually at the CFO level, you can fund it and promote it. Great. Well, I think it'd be a great time to take some questions from our audience. This is the quietest group of CFOs I've ever sat with.
Can you share specifically how you're using machine learning today to reduce risk in your specific functions?
The machine one?
We're not. So I can share that very, 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 very honestly. So we're not doing anything with it yet.
I can share. We're doing a lot more data correlation and identifying, for instance, from a fraud scheme perspective, by correlating multiple sets of data. So I should say, I joined the organization as a chief audit executive, right? So I came in with the view of more risk management, internal controls, processes, et cetera. It is very hard when you're trying to find the needle in the haystack through the typical approach of, I'm going to go take a sample and see if I get lucky. Through technology, we started implementing better processes for data analysis through Gen AI, through automation and data analytics. And the way I described that to the audit committee was, I'm trying to, instead of finding the needle in the haystack, remove the haystack so that I can actually evaluate the needles. Right, so there's a lot of use cases that you can start very small, T&E, accounts payable, accounts receivable, duplicated payments. Many things that are not necessarily massive areas, but what it does is starts flexing the muscles for people to start looking at the technologies and start applying to use cases. Last thing I'm going to say, many companies will tell you, oh, we can do everything. Yes, they can. The problem is, how do you configure those systems and the correlation necessary to be able to structure the use cases and have better visibility around data?
One thing I'll add is we don't really use machine learning, but it's something that the IRS is using, and it's interesting. They are using that because, again, a lot of companies for a long time have not undergone audits, and even if they do, the IRS has had trouble identifying issues. The IRS has realized that now with a bigger budget, they can invest in this space, and they'll be able to find that needle in a haystack and be able to identify risks and issues.
And that's a great point, because your external auditors are starting to use the technologies to be more effective and efficient in their audits.
No, not machine learning, but there are certain risks that are inherent to our business, for example. And as we modernized our ERP, we have built very robust reporting to be able to track and manage things. So I mentioned earlier, commodity risk is very, very big for us. You'd think that flour milling is a pretty simple business, been doing it for 2,000 years, milling flour, baking bread, and then eating it. But it is much more complex than I imagined when I came. We sell most of our sales are out 3, 6, 9, 12 months. With a volatile commodity that moves up and down by the minute on grain exchanges. And so we have built robust reporting so that we know when to hedge, how much our exposure is at any one point in time, but it's not machine learning.
And I'd just like to make the point, with you think about machine learning, I'm old school. A lot of things like classic process control charts are not being used, and more than enough to enable your company to actually reduce these risks. But if you use machine learning for filtering and actually getting the right data and eliminating the 99% you don't, that actually can be extremely helpful pairing. So a lot of the existing tools for managing risk still work, but in this, when we're swimming in data, adopting some of these filtering techniques can be really powerful.
Okay, question. So general commentary is that we are at an inflection point. Global economy is at an inflection point with the number of threats and risks posing, across, for all economies, right? What would you say are your number 1 or 2 major threats or global risks that are facing your companies?
Great question. Look, each one of us has a different business. We're many CFOs in this room. Just the three of us have very, very different business profiles. We are very affected by climate. We're an agricultural product. It's grown out in the field. 2 years ago, the oat crop was decimated by a drought in Canada. The price of food is up, and it's not going to be managed by the Fed raising interest rates to bring it down. It's supply and demand. It is economics 101 in its rawest form. And as climate change makes crop cycles less predictable, it really does become a significant threat around the food supply and around costs. So that's a big one for us, but it's not going to be the same for you.
Yeah, for me, it's the security of our cash. So it's from external people trying to get access to our cash mostly through posing as vendors, like I was saying earlier. So they'll email us an invoice, say, hey, can you change the bank that this needs to go to, and they'll get in total dialogue between us. I mean, we've gotten this figured out now, but I've seen it at other companies too, and so now just it's a simple thing for us. We pick up the phone and we call vendors, so you actually get someone on the phone to confirm that, and someone that not the the number in the email. So, but that's for us. It's 100%. It's security of our cash.
We actually do something we call a penny test.
Oh yeah.
So if there is any wire change,
Yeah.
we're going to send
That's
a
good.
penny, and then we're going to call and
Yeah.
make sure that they receive the penny in the account that it's supposed to.
Yeah.
And so, again, it's phenomenal and scary how easy it is to intercept an email and pose as someone you are not.
Yep. It is, it's very scary.
Yeah, and then I think the human factor plays a lot as well, right? I always like to say an example. So we had a situation where I got an email from what it looked to be the CFO saying, "Hey, David, how are you? Good morning. Can I ask you a favor? I need you to go talk to the controller. I'm about to get on a plane. I need $1 million to be wired to these specific accounts." And you know, the interesting thing, and we saw it, and it was actually his email address, right? His email address had been compromised. And when I went to the cybersecurity team immediately, they were like, "How do you know?" I'm like, "He never says good morning." Right? Whenever he needs something, he goes straight to the point. Right? So it's a social engineering component that you have to sort of look at it. And even if that would have been the case, the first thing is get confirmation. Pick up the phone and say, "Hey, I just got this call from you, and can we get confirmation?" Right? So again, I think the social engineering piece is getting better and better.
Yeah.
But in many cases, it goes back to what are the pure basics, right, of the process, and use your intuition to try to avoid.
It's such a great example and such a great point. He never says good morning, right?
Yeah.
One of the things that we need to watch out for, I've been in companies where the CEO says, "Don't question me, just do as I say." And they create an environment of fear. And the cyber criminals can take enormous advantage of that. Or we as CFOs can have an environment of fear. People are afraid to pick up the phone and call us. Everyone in our organization knows if they get a request from me through an email and they have any doubts, pick up the phone and call me, or just don't do the wire. And I will accept that, and even if somebody doesn't get paid, that's okay. And so we need to create an environment of trust where people feel empowered and can say no. It's up to the CEO to do the same and to back it.
Yeah, but I think also to answer the question, right, I think the regulatory environment is changing. We heard it this morning. It's getting significantly more complex. The geopolitical environment is also getting significantly complex, right? And I do believe there's going to be a sort of a shift in certain dynamics as we see the geopolitical environment shifting. But I also like to step back a little bit and say, look, particularly as a chief risk officer, right, or in that mindset of the chief risk officer, you don't need to have a crystal ball to know everything you're gonna face. Just look back the last 10 years and do that exercise with your team. In the last 10 years, how many events did you have to respond to? Whether it was a natural event, political event, economical event. And you're gonna see that it's very cyclical. Every 2 years, you're dealing with something new, but at the end of the day, it impacts the same areas within your organization. It could be your supply chain, depending on the type of organization that you are. It could be cash, it could be the investment piece, it could be sales. So I try to step away from saying, hey, don't try to sort of figure out what the next event is gonna be. Think about as how ready are you to respond when something happens. And the more you ingrain that in your normal process, the more effective you will become in managing the risk on an ongoing basis.
And why don't we take one more question, and then we'll give each of the panelists to give some advice or 1 or 2 points to take away from Jim.
Hi, I'm Dan Belbustier I'm CFO of a small insurance company. One of the things we wrestle with a lot is laying out our risk register, and we update it. In practice, what is useful to bring up to a board level? Like, these things can get ridiculous if you let them. We've sort of settled on, those folks are not going to pay attention to more than 8 or 10 things. But first off, what do you normally bring them? And second, do you have any good way to get real engagement around them rather than just kind of those are a risk, check the box kind of thing?
Yeah, so I mean, I would definitely recommend 2 things. Yes, do the exercise with the teams and engage a broad enough team to have visibility to what are truly those top risks. try to balance of not just going all compliance, all operational, all financial, all strategic, but really focus on having a good mix of what those top risks are going to be. If you have an ERM program, more likely you're going to be more towards strategic type of risks. And what are those risks that might prevent you from being able to achieve your strategic goals? But I do agree, you don't go to the board with your full register of 300 risks, 1,000 risks that you may find across the organization. You have to narrow it down to what are really the things that can bring the company down, right? Because that's where they want to be focused on not only the risk identification and the quantification, but what are you doing about it? Now, be mindful and careful, because as part of that process, you might be creating a lot of documentation that the regulators would love to see that you identified a risk and you didn't do anything. So that's the other exercise that I tell people. As you're going through that process, make sure that you're having the right support from your legal and compliance teams to ensure that you're not leaving undocumented mitigation actions out there that clearly gave you visibility that something could go wrong. The last thing, as an auditor, I can tell you, in many cases, auditors and risk managers, we tend to exaggerate things a little bit, right? Because we freak out when we see the risk. I think it's always good to have that balance, and particularly as a CFO, you can bring that balance to say down and to tone it down and really say, what is the real risk here? And how can these really impact the organization, and make sure that you're not just elevating risk for the sake of elevating risks. All boards are going to react if you don't have cyber in there. They want to see it, they hear it in other companies, they want to see what you're doing. But I tell people, cyber is very broad. You have to be more specific of what are the things that you're concerned about cybersecurity. Is it your ability to patch systems? Is it your ability to update systems on a regular basis? Third-party risk management, right? That you may not necessarily have robust processes around third-party risk management. It's being able to narrow it down to specific areas with specific actions, with specific quantification.
As a privately held company, we've got different concerns than the public, so I'm not as worried about what's the documentation I'm leaving, so it's a little bit different. But we have a dozen risks that we have identified to the board, and we do something simple. And what's nice about our company is the CEO gives the report, not the CFO. So the CEO then is taking responsibility for risk mitigation as well. And once a quarter, when we have our annual board, our quarterly board meeting, he presents a simple scorecard, and it's a green, yellow, red scorecard. And if it's yellow or red, it's what's the mitigation. And if we see the risk increasing, staying flat, or decreasing. It's a really simple, very visual scorecard on those 12 critical risks that we see and have identified for the company.
And Sarah, given your role in this burgeoning biotech industry, it's probably, we still haven't even written what is going to be accomplished in that area. What are some of your thoughts on when you report risk to your?
Yeah, I mean, I think it's a great point that Peter's brought up too. I think the CEO needs to be involved as well. It's not, it's on us to make sure it happens, but the CEO should be in full agreement with risks that are identified, so that when it gets up to the board level, he or she is aligned with what's being presented. So I think that's important, and just to kind of narrow down to the top 5 or 10 or whatever makes sense for your organization, and kind of keep it focused, and try to make it engaging with the board, so there's a conversation around it, because a lot of board members may have some good ideas or identify something that should be thought of as well. It's definitely a communicative type, it should be a communicative type presentation and discussion.
And as a quick follow-up, one thing that we saw it worked a lot and it really resonated with board members was we started doing deep dives on a quarterly basis on very specific risks. So we will give them a little bit of an update on where we were with that risk and the mitigation factors and everything. But back to the ownership discussion, it was not the CFO or audit or the head of risk management. Bring in the right risk owner to the conversation. Have the chief information security officer sit in front of the board and have those regular conversations or whichever risk you're presenting, and engage them as part of the conversation to ensure that they are also given the opportunity to provide the right level of visibility to executive management and the board of directors.
Okay, and just in conclusion, is there one or two pieces of advice or observations you'd like to share with our audience today?
I would just say, risk is one of those things that's hard to dedicate the time to it. It's not any one of us' favorite activity to do, but I think that in these days, it's very important. So just take that time to just carve out, whatever it is, annually, however it makes sense in your organization, just to dedicate some time to really thinking about the risks that the company has, identifying the top risks, and how it's mitigated, and not just, okay, this is, we're just going to do X, Y, Z. Like, make sure it's actually going to work and it's actually going to prevent something from happening.
Yeah, I think I would just add on the tax side, tax is very complicated, very hard to get a straight answer out of a tax person. So it is something that, we've seen companies really look for certainty, especially for important issues. And, that is something that certainly, tax insurance has been used quite extensively over the past few years. And we've seen exponential growth as companies really look to navigate the complexity and risk associated with tax issues.
I would say, I like to tell people, risk is similar to fire. If you use it right, it can be great for you. But if you don't control it, it can destroy you, right? So don't be afraid, but just go in with eyes wide open into what the potential consequences could be.
And I just wrap up saying, think about being proactive, not reactive, because it's a lot better to be proactive than reactive.
And just to quickly wrap of the panel, it's like risks are coming your way, but if we actually move faster than those risks, we'll mitigate them and then actually take an advantage of that. So first, let's give a big hand to the panel here. Thank you. And I'd also like to thank the MIT CFO conference. Our panelists will be available to talk to you and have some follow-up conversations. And thank you very much.